So right now, we're looking at a pretty much $300 trillion fixed income problem. And the problem in that marketplace is that the real rate of return is negative. So for those listeners who don't know what a real rate of return is, what you simply do is you take the yield you're getting on whatever debt instrument you hold and you subtract the real rate of inflation from that APY. And if you get a positive number, then you've made a good decision, because at the end of it, when you take into account price increases, you're going to be able to buy more things at the maturation of that note. But if the number is negative, like if you're getting 5% on a US Treasury bill and the real rate of inflation is 10%, you're getting a negative 5% return, which means at the end of the year, you're going to be able to buy 5% less stuff. And what happens is when the interest rate is negative, you should be spending and investing your money as you get it. You shouldn't be putting it into a savings vehicle that doesn't allow you to buy more stuff to increase your purchasing power, because that's really what it comes down to. Nominal numbers, which are the numbers on the computer screen. And if you look at those numbers, everything is going up and to the right and it looks great. But real numbers take into account price increases. And if your real numbers are going down while your nominal numbers are going up, you get a false signal. You get a false signal of economic growth. You get a false signal of profit, when in reality, your balance sheet is truly declining. So this is a multi-$100 trillion issue. And with Michael Saylor and MicroStrategy, we're just starting to see, yes, with Bitcoin, we've re-engineered money. And now we're moving to the next step of this evolution, which is integrating Bitcoin into debt products. And we are going to re-engineer debt.
Yeah, and I think a lot of Bitcoiners are familiar with the classic 60-40 portfolio, and we've been targeting this 40% bond portfolio as something that maybe spot Bitcoin would come to eat up eventually. But we're not exactly seeing that. What we're seeing is more of this Bitcoin-backed bond, like you just mentioned with MicroStrategy, with the best performing corporate bond. So let's go there. Why don't you explain how a MicroStrategy corporate bond gives a bondholder exposure to Bitcoin's price appreciation, but limits the downside risk?
Yeah, and before I even go into that, I would like to first say that if you're on the personal level, one of the best things you can do is add Bitcoin to your balance sheet, and especially if it's your savings vehicle, because if you're saving in Bitcoin, the volatility doesn't matter. Your low time preference, and you're going to get a 60% CAGR. Or even if that gets cut in half and you have 30% CAGR, it's going to outperform everything. And that concentration of Bitcoin in your portfolio is going to allow for the diversification decisions you make to underperform. So on a personal level, it kind of makes sense to just add Bitcoin to your balance sheet. But now we're talking about businesses and corporations, and the dynamic changes. It's one thing for an insurance company to take Bitcoin and put it on their balance sheet, and God forbid a hurricane hits or a catastrophe happens. But what happens if that's in the middle of a bear market and the amount of you invested into Bitcoin happens to be down 40 or 50%? Now, we know that's only temporary, right? Bitcoin's price can go down 40, 50% in 5 days very easily, but it's never going to go down that much in 5 years. So for the personal level, you can just wait the 5 years and you're going to end up in a better, stronger position. But at a company level, you might need to make a business decision, or you might want to take advantage of a business opportunity. And if it happens to fall upon a time where Bitcoin's in a bear market, you now can't act on that opportunity, because you would be like the banks. You would be locking in losses, these mark-to-market losses, if you had to sell that collateral. If the banks couldn't take their treasuries and borrow against them at par, they would have had to lock in losses. So that's why the Fed created the bank term funding program, so that they could bring those losses to a borrower, hide those losses so that it didn't affect their balance sheet and actually become a realized loss. And that's what we have here in Bitcoin. We have the opportunity to combine Bitcoin with traditional debt products, which limit downside volatility, limit downside risk, enabling businesses to write liabilities against that debt instrument versus the Bitcoin asset on the balance sheet. And then also capping the upside. That's the price you pay, right? You still don't get the 30 or 60% CAGR one-to-one for Bitcoin. Your upside is capped. But Bitcoin performs at such a rate that the upside that's being produced, when we went back to the Treasury example where we were at 5% on a T-bill, 10% real inflation, negative 5%, Bitcoin's potential in this product is for 10, 20, 30, 40, 50% APY. And this is why we see the demand that we see for MicroStrategy. anybody that's looking at this and saying this isn't sustainable doesn't understand how prices work, because interest rates are the price of money. And Michael Saylor is borrowing money at 0%. Plus, the convertibility premium is at 55%. So this price tells you right off the bat, there are large amounts of demand for this product. If there weren't, the interest rate would be higher in order to attract demand. The convert premium would be lower in order to attract demand. So we can look at that price signal to understand that, yeah, this multi-$100 trillion marketplace, they need these types of tools. They need the next evolution of not just money to plug into their business plans, but of debt, of re-engineered debt that gives them downside protection, but then upside exposure to the best performing asset in the world.